Hello and welcome to TransUnion's podcast series. Thank you for joining me, Praveen Mudley, Solution Advisor at TransUnion Africa. We welcome you to today's discussion on how rising interest rates in the Kenyan economy is squeezing disposable income of consumers, and how targeting the right risk profile can lead to responsible and profitable lending by credit providers. Kenya's central bank has raised the reference rate over the past few months by 300 basis points to 11.5%. This has changed the interbank rate, which is the rate that banks lend to each other, to 15%. This impacts consumers, as the repayment rate on loans is now 24% and above, and empirical evidence has shown that interest rates greater than 20% almost leads to higher defaults. To put this into context, Kenya has been here before. The 1993 Goldenberg scandal saw a surge of money supply into the economy. This led to interest rates of almost 45%, and inflation touching record levels of 72%. This led to massive foreclosures on mortgages, and savings almost instantly dried up overnight. Although we're not facing this current situation, this gives a good indication of where the economy could go if the situation deteriorates. The key question is, how does TransUnion assist during these economic times? The simple answer is the use of real-time data and analytics derived through scoring solutions offered by the Credit Bureau. Lending responsibly is key to any credit environment, whereby loans are granted to consumers who can afford them. Profitable lending is also important. In order to stay in business, credit providers need to remain profitable. Default payments lead to lower profit margins and lower credit risk appetite by credit providers. Hence, responsible and profitable lending is key in tough economic times. Making use of scoring solutions during these tough economic times are essential. These solutions afford credit providers the ability to assess risk upfront on a consumer on whether they have the ability and the affordability to repay a loan. Consumers are heavily affected when interest rates increase. In these tough economic times, their disposable income is squeezed and they have to tighten their belt around spending. They generally inherit two behavioral traits during these times. One, they default on existing loan facilities. Or two, they fall in what is called a debt trap, whereby they engage in distressed borrowing by taking out alternate and additional loan facilities to settle and fund their existing lifestyle. It is therefore essential for credit providers to manage current and new customers through the management of risk. Scoring solutions assist lenders in the ability to reassess and monitor risk on their book throughout the credit life cycle. Regular and dynamic changes in risk have the ability to provide real-time indicators of stress across the credit life cycle. Furthermore, a new customer can be assessed when a loan application is received using a scoring solution. The scoring solution provides the lender with a score that reflects the risk of the customer, i.e., whether the customer has the ability to repay the loan and what is the risk of default. Solutions such as scoring mechanisms are available to lenders during these tough economic times. Lending needs to be managed so that it is done both responsibly and profitably. Scoring solutions will assist with the management of both current and existing loans to ensure that credit providers remain profitable during these tough economic times. Thank you for joining us today. I hope you enjoyed this podcast. If you have further questions or queries, please feel free to visit our website. Goodbye.